And now we're speaking with Gavin MacLaren. He is the head of Freshfields Energy and Natural Resources Practice. He's based here in Singapore. So thanks very much for coming in.
Good to see you.
Tell us a little bit about Freshfields.
So Freshfields is a large law firm which focuses across all industry sectors. My particular focus area is the oil and gas sector, energy and natural resources in the Asia-Pacific. And I've been practicing in that space for 20 years.
And so what are you doing here at this Oil Council event?
Catching up with old friends, many clients, colleagues, and it's good to get everyone together in one room for a couple of days, and very efficient use of my time.
The big topic on everyone's lips that we've been talking to is obviously the plunging oil prices, which have gone down precipitously in recent months, and I'm sure you've been talking about that as well. What are you doing about that as you network here, as you go about your business in Asia?
Well, our business in Asia is sort of primarily in three categories in the oil sector: M&A, project development, and international arbitration. So looking at each of those in turn, the M&A market for the last 2 years has been a very strong seller's market. We've acted on a number of sell-side disposal processes where you would have multiple bidders achieving very attractive prices. Companies such as Hess, who have run international disposal programs during $100 oil, have accumulated significant capital as a consequence. What we have seen over the course of the last 6 months is a very rapid transition from a very strong seller's market into a neutral market, and then more recently into, you could describe it as a buyer's market or a state of paralysis. At the moment, it's not fully tested, but it does seem that there's going to be a disconnect between vendor expectation and buyer expectation, or at least buyer sentiment and willingness to transact on long-term price forecasts which sit above the current spot by a very significant margin. So we see that shifting over time to the extent that distress starts to appear and there are distress processes, but at least for the moment we think that it's going to be quite hard for people to commence processes to conduct significant asset rationalization exercises. It's a high-risk decision to go forth in this market and buy something.
The oil and gas industry is sort of a high-risk industry to begin with, so this puts a little extra pressure on everyone, doesn't it?
Yeah, it does, and it is. And I think on the project development side, we're going to see a sort of a very significant diminution in investment. CapEx is going to come under enormous focus at all organizations. To the extent that people are pre-committed to doing a particular development, then those will presumably proceed, but at a sort of with a very fine eye to keeping costs under control. But in terms of greenfield new project development, I think we will see very limited expenditure this year. And on our international arbitration, we will, I think, are going to continue to see more and more dispute resolution work, both as between industry participants. So we are acting for a number of LNG buyers who are looking to renegotiate prices, E&P companies looking to renegotiate their service contracts, service providers seeking to resist that, and then though we tend not to be involved in this, the service companies are going to be putting pressure on employees over pay conditions, interactions with unions and so forth. So I think the dispute resolution piece of the business is going to be an increasingly large part of it. I suppose the other factor that we think will come to play is a significant part of our work recently has been engaging on behalf of oil companies with governments, or as between governments, to try and resolve outstanding issues, whether they be tax disputes, whether it be disputes on cost recovery, whether they be international boundary disputes between governments. And so I think a large portion of our work is going to continue in the low-cost environment in that area, because each of these disputes has a proportionately greater impact now.
How are governments and regulators responding to this? Are they jumping in to help companies and to keep the industry viable in this situation, or are they keeping a hands-off approach?
I think just like the M&A market is going through a transition period, at the moment I think governments are going to be going through a shift in their thinking. Until very recently, the story was resource nationalism. And so if you look at the larger markets like Indonesia, there have been a series of measures introduced to sort of create greater national control, greater national involvement in the oil and gas industry. And the industry would argue often at the cost of new investment, sometimes at the cost of activity and production volumes. And so if you look at the production profile in this part of the world, production is not, in Malaysia it's growing, but in Indonesia it's falling and has been for some time. So with regime change in some jurisdictions and a recent history of resource nationalism and a history of falling production levels, it may be time for governments to revisit their priorities. Do they want to get every last dollar out of every barrel produced, or do they want to increase production, which means an investment in the relationship with the organizations with the capital to deploy, to explore, to develop, to produce?
I guess that's a difference between having a short-term vision and a longer-term vision.
Yes, and I think now may be a good time, even if prices recover quickly next year, and they may or may not, but even if they do, it's a good time for governments to sort of rethink their priorities for the industry and to decide what how they want to position themselves and how they want to position investment in their countries going forward from here.
I know your area of focus is Asia-Pac, but your company is global. Are you noticing a difference in this region compared to other regions, some of your colleagues that are working in maybe Europe or North America?
I think the distress situation will probably appear more quickly in Europe and North America. We also do a lot of work in the mining sector, and the mining sector has been affected by falling prices for longer than the oil and gas sector, and certainly if that is a forward indicator of what's going to happen in oil and gas, that story is quite sort of a troubling one for certain segments of the industry. There are companies that we've worked with who have, over the course of a 2-year period, gone from, say, a £2 billion market cap to 50 or 60 million pound market cap because they have debt due to be refinanced and they can't refinance it. They don't get a rights issue away. They haven't been able to dispose of assets quickly enough or raise capital, and they end up with funds positioned in their bondholder group who've come in at a significant discount to face value and who are effectively transferring from the equity to the debt the value that those assets have. So I think in the oil and gas sector outside Asia-Pac, there's been much more entrepreneurialism. There has been a greater degree of leverage applied to production, and once the current hedging position expires and incremental costs of production exceed current prices, you will see a very significant shift in the way in which the market treats those organizations and in the behaviors that they have to adopt to deal with potential distress.
Do you think we'll see a shakeout? Some of the weaker, obviously some of the weaker ones will fail.
Yeah, I mean, I think the lesson to be learned from the mining experience and from past experience in the oil and gas sector is hope for the best and plan for the worst. And if you look at, the best option for many producers is going to be a V-shaped recovery in oil price. And if it's quick enough, then they will escape relatively unscathed. However, planning for that and hoping for that is not a good strategy, because if it does become a long U-shaped recovery or there's an extended period of price pressure, the quicker you act to address that, whether it's by rights issue or by renegotiating your debt or by disposing of assets to raise cash to allow you to continue to meet your commitments on an ongoing basis, the sooner you do that, the better. And there are pools of capital which are looking for opportunity at the moment. The private equity houses are still sitting on significant monies which they could deploy. They are looking for opportunities, so perhaps you will see some sort of risk-reward sharing, perhaps not. But act now, act quickly, be on top of the issue, and don't assume that a V-shaped recovery is what will come through.
It'll be interesting to see in about 5 years who made the right call.
Yeah, there'll be money to be made and money to be lost, certainly.
Definitely. Well, thank you very much for coming in and talk to us today.
Thanks very much.
We've been speaking with Gavin MacLaren. He is the head of Freshfields Energy and Natural Resources for Asia-Pac. He's based here in Singapore.